Good morning, everyone. Welcome to this session on valuation of equity shares. In my previous lecture, I have taken all the concepts of the valuation of equity share. We started with the dividend discount model, that is Gordon's model, and various aspects of the dividend discount model. That is, if a particular investor holds the share for 1 year, and secondly, if he wants to hold till infinity, there are different methods. That is zero growth rate, in which it is assumed that the company is paying a fixed rate of dividend every year. Secondly, we taken the situation in which the company is paying at an increasing rate, but the increasing rate is fixed. For example, 10% increase every year. So zero growth rate and constant growth rate are slightly unrealistic assumptions. And the last stage in the dividend discount model, we have taken the two-stage model and the three-stage model, which are more or less more practical approach. In the second stage model, we have seen that the dividend is growing at extraordinary rate for a certain number of years. Then the growth rate settled at a normal growth rate period. For example, the company is paying dividend at 10% for 5 years, and then from 6th year onwards, it is settled at 5%. Thereafter, means till infinity, till perpetuity, or for a very long time. In the three-stage model also, we have seen that the dividend is growing at an extraordinary rate for a certain number of years. Then a transition period came, a certain percentage it has been reducing, and then again settled down to a normal growth rate, which will continue thereafter or till infinity or for a long time to come. Then we come to the earning-based model. We have seen the earning-based model of the Gordon, Walter, and the price earning multiple. In the earning based model, it is basically assumed that the investor is taking the present value of EPS, and it is assumed that it is a growth oriented company. It is actually withholding its dividend and placing more emphasis on retaining its earning and investing in profitable growth opportunities. Lastly, we have seen the free cash flow method. In the free cash flow method, there are two aspects, that is free cash flow to firm and free cash flow to equity. Free cash flow to firm is basically an unlevered cash flow, because it is the cash flow which is available to both the debt and the equity shareholders. On the other hand, the free cash flow to equity is a levered cash flow, because it is the cash flow which is available to the equity shareholders only. And this free cash flow to equity method, while valuation of equity shares, is a more practical approach, and most of the companies actually follow this method, that is free cash flow to equity. And then we come to the valuation of right shares. We have taken one question on valuation of right shares also, and lastly, we ended the session with the valuation of preference shares, means valuation of both redeemable preference shares and valuation of irredeemable preference shares. So this was all about our previous lecture. Any question which comes to your mind, I will happy to attend. Otherwise, I will begin with the practical problems in valuation of equity shares. I hope you got the assignment for this and taken the printout with you. Otherwise, you may also, this assignment question is in front of you, and you can also take the screenshot of that so that you can solve this question along with me. Okay, fine. So let us begin this session on valuation of equity shares, practical problems today. Now, let us look at this first question. First, understand this question, and we will then solve it. The question is, company has a book value per share of 137.80. Its return on equity is 15%, and it follows a policy of retaining 60% of its earning. Now, book value per share, book value we have discussed during our lecture on fundamental analysis, that book value is actually the net worth and it is actually the equity. So it is same as equity. So book value per share or equity per share is given and return on equity is given, which is 15%. So on this basis, you can easily calculate the EPS. Okay. And company is retaining 60%. Company is retaining 60%. It means it is paying 40% dividend. And the opportunity cost or the discount rate or the minimum required rate of return is 18%. So what is the price of the share today? You have to calculate the present value or the intrinsic value in this particular question. Now I will stop sharing it and let us try to solve this question. Now, it is given in the question again, book value per share. So it is nothing but the equity per share or the net worth per share, and return on equity is given. So you can easily calculate the earning per share or EPS. So it will be book value per share. It will be book value per share multiplied by the return on equity. Book value per share is given in the question 137.80, and return on equity figure, it is 15%. So let us calculate this. It is coming to 20.67. So coming to 20.67. Now you can, on this basis, you can calculate the dividend also, dividend per share. It is mentioning in the question that the company is retaining 60% of its earning. It means it is declaring dividend at 40%. So dividend per share will be, EPS into dividend payout. EPS into dividend payout. EPS we have calculated 20.67 multiplied by dividend payout, which is actually 40% because company is retaining 60%. So let us calculate it. Actually coming to 8.27. Now we have got the dividend per share. We will put this figure into the formula, which is P0 is equal to D1 upon K minus G. Dividend we have calculated 8.27. We will take 8.27 as the dividend at the end of the year. We can safely assume that because actually EPS is available at the end of the year. And on this basis, we have taken 8.27 as the D1. Otherwise, you can given a note that this 8.27 figure is at the current day rate, and you can multiply it by the growth rate also. So both these methods can be followed. But you can safely assume that this 8.27 is the dividend at the end of the year. Since EPS is at the values at the end of the year, balance sheet figures are available at the end of the year. So you can safely assume that 8.27 is the D1 or dividend at the end of the first year. Cost of capital is given 0.18 minus the growth rate. So in this case, you have assumed, you have observed that growth rate is not given. You have to calculate it. Calculate the growth rate, and basically, growth rate or G is equal to, that is B into R. In earning based model, that can also be taken B into R. What is B? B is the retention ratio multiplied by return on retained earnings, or it can be interchangeably used as return on equity also. That is return on equity also. Now let us calculate the growth rate. B, that is retention ratio. Retention ratio is given in the question. That is 60%, 0.6, and multiplied by R. That is the return on equity is also given in the question. It is 15%. So let us calculate it. This 0.09 or 9%. The growth rate is 9%. Now let us apply this into this formula. D1 we have already calculated 8.27. This is the cost of equity which is given in the question, 18% minus the growth rate. I think that is 9%. Calculate this. So it is basically coming to 91.89. 91.89. So this 91.89 is the answer, that is P0. Now, one thing I want to clarify is that sometimes some of the students may have a doubt that why this return on equity and the return on retained earnings are taken as same. The reason is that these two figures can be used interchangeably. I will tell you the reason. The dividend is declared in this particular question. The dividend is 40%. Dividend payout is 40% because the company is retaining 60% of its earning. Since the company is retaining 60% of its earning, the amount which can be profitably invested is the 60% only, not beyond that. Because whatever the company has declared by way of dividend, that is the 40% portion, is gone. It cannot be come back. So that 60% portion the company is retaining can only be invested. So that is retention on retained earnings or whatever has been retained, that is the return on equity portion. That equity portion is left with only the retained earning portion only. So that portion can only be invested. So this can be used as interchangeably. This return on equity, you either take it as return on retained earnings or return on equity. Therefore, the retention ratio is multiplied by return on equity to arrive at the growth rate. Okay. Now, how we have proceeded in this question? In this question, book value per share is given and return on equity is given. Book value is basically the equity. So if equity per share is given and return on equity is given, we can safely calculate the earning per share. On the basis of earning per share, dividend per share is calculated because dividend payout ratio is given. That is 8.27. Then we apply the formula, put the figures into the formula. D1 we have already calculated 8.27 upon the cost of equity 18% given in the question, 9% we have to calculate, that is growth rate is retention ratio, whatever the company is retaining and whatever amount the company is generating from that retention. So growth will be retention ratio into return on retained earnings or return on equity. This retention ratio 60% given in the question and this return on equity 15% is also given in the question. We multiply these two figures and then we arrive at the growth rate which is 9%. Again, put the figures into the formula. 8.27 is the dividend, KE, cost of equity, minus the growth rate, 9%. That is 91.89. This is the present value of the equity or the price of the share today. Okay. So this is what of the solution in case of the first question. Any doubt, any query you have, please ask. Yes, no information is given, so you can also calculate this by Walter's method also. So I will give a solution Walter method also so that your doubt is more clear. Walter's model is there, but yes, you can calculate on the basis of Walter's model also. So let us solve this question on the basis of Walter's models also. So I hope you have just gone through it. I am rubbing it. So if we take a Walter's approach, So this Walters formula is equal to D plus E minus D into R upon K divided by K. So this D is the dividend per share, E is the earning per share, R is the return on equity, and K is the cost of capital. So put the figures, let us put the figures into this formula, the Walters model. D we have calculated, that is the amount was actually dividend per share 8.27. 8.27 plus E minus D. Earning per share was 20.67 we have calculated, minus D 8.27, and we multiply it by our return on equity is actually given in the question, 0.15 divided by 0.18, 15%, and K is 18%. We divide it by K, that is 18%. Okay, so let us calculate it, this question by the Walters model. So this portion is 12.4. Okay, 10.33 plus 8.7. 18.60. So it is coming to 18.60 divided by 0.18. 18.60 divided by 0.18. 103.35. So as per Walters model, the answer which is coming is 103.35. So this is somewhat similar to calculate in this question. The Walters formula is this. We put the figures into the formula. Dividend 8.27 is given. 20.67 is the earning per share we have calculated, minus dividend per share, multiplied by the rate of return on equity, which is 15%, and this is the discount rate, 18%. So 18.6 upon 0.18, and the present value as per the Walters model is 103.35. So I hope you all are getting the same answer also. So this problem can be calculated both by Gordon's approach as well as the Walters approach, because nothing is given, is specific given in the question. If it is asked that it has to be calculated on the basis of Gordon's model, then Gordon models will be applied. And if it is asked in the question that Walters model has to be applied, then Walters model will be used. So I hope this is clear to you. Any question in this? Fine. So let us move forward to the next question. Now come to the second question. Sai, you are getting 122.5 as per the Walters model or as per this approach, Gordon's approach? I think Sai, you check it again at your end. It is coming to 103.35 only. 103.35 only. So Sai, I would request you to check it again at your end. Okay. Now let us get to the Second question, current dividend is given, which is 2.5, discount rate is also given, 10.5% growth rate is given. So you have to calculate the present value of stock of ABC Limited. So this is very simple question. I have taken examples in my previous lectures also. So let us just calculate the first portion and then we come to the second portion. Okay. So Sai, I hope you have checked your answer. So let us stop sharing it and let's solve this question. First aspect. Okay, now fine. Let us calculate the first part, that is calculate the present value of stock of ABC Limited. This is the question 2. You know the formula. So it is actually P0 is equal to D0 into 1 plus G upon KE minus G. Alternatively, it can also be written as D1 upon KE minus G. So let us put the figures into the formula. D0 is given, current dividend 2.5 multiplied by 1 plus G, the growth rate which is 2%, KE, that is the cost of equity, 10.5% minus growth rate, that is 2%. So let us solve this question. .55 divided by 105 minus 100. So this present value we are getting is actually 30 rupees. So are you getting this 30 rupees? Okay. I hope it is clear, very simple to calculate. Now let us get to the second part of this question. What it is asking? It is asking that is the stock overvalued? Is the stock overvalued if the stock price is rupees 35? Stock price is 35 means the current market price is 35. Return on equity is 9% and the EPS is 2.25%. And you have to calculate or show the calculation by following the price earning multiple approach and the earning growth approach. Okay. We will take it step by step. First, we take the price earning multiple approach and then we come to the earning growth model approach. First, take the price earning model approach. Price earning approach. In this case, P0 is equal to market price per share to this market price, you have to calculate it. Just a second. P0 is equal to price earning multiple multiplied by the earning per share multiplied by the earning per share. So in this question, the EPS figure is given, but the price earning multiple is not given. So you have to calculate the price earning multiple. How it will be calculated? Let us see. What figures are there on the basis of which the price earning multiple can be calculated? The one figure which is given is return on equity. So on the basis of this return on equity, you can calculate the price earning multiple. Price earning multiple is equal to 1 upon this return on equity, that is equal to 1 upon, what is the return on equity? It is 9%. So what is the figure? Let us calculate it. 1 upon 1.09. That is 11.11. 11.11 is the price earning multiple. So P0 will be 11.11 multiplied by the EPS figure which is given, that is 2.25. So your answer will be 24.95 or 25. So 25 is the answer. On the basis of price earning multiple, the present value which is arriving at is ₹25. Now, the doubt may arise in your mind regarding why this 1 upon return on equity is taken as the inverse of the price earning ratio. Price earning multiple can also be taken as the inverse of cost of equity. For cost of equity, this is also known as the minimum required rate of return. Minimum required rate of return. That is, KE is also called the minimum required rate of return. What is the minimum required rate of return? As we have discussed, that this is the return which the investor is expecting that he will receive it. Now, in this second question, it is assumed that the company is following an investor is following an earning based approach. Means he is assuming that the company will retain its profits. So the calculation is on the basis of the present value of future EPS, not the present value of future dividends, present value on the basis of future EPS, because on the basis of the question, it can be easily deduced that the earning based approach is being followed. So, since the earning based approach is followed, this return on equity or the minimum required rate of return approach can be taken as same. This return on equity and this KE, that is the minimum required rate of return. What is the minimum required rate of return? Which the investor is hoping in case of earning based model. In case of earning based model, he is hoping for the future EPS, that is the future EPS which the company will be employed in profitable growth opportunities, and whatever return will be applicable to him. And that is exactly the return on equity. That is whatever the equity or the retained earning portion which the company is investing and whatever return it is getting onto it. So on the basis of earning based model, these two can be the minimum required rate of return and the return on equity can be used interchangeably. Now the next aspect, why this inverse, that is 1 upon K or 1 upon R ROE. I will give you a simple explanation on this. What is a return? Return is equal to earnings yield plus I will take entire thing, just wait for a second. So earning yield is, return is basically return is earnings yield plus earnings growth, earnings yield plus earnings growth. Earning yield can also be written as earnings upon price, earnings upon price plus earnings growth earnings upon price plus earnings growth. And what is the price earning ratio? Price earning ratio is price upon earnings. And the price earning ratio is price upon earnings, that is market price per share upon earning per share, right? Price earning ratio is equal to price upon earnings. So this is basically, you can say, earnings yield upon earnings growth or price upon earnings. So you can say this is basically it is the inverse. Or if you say the return, so return is the earning upon price plus earnings growth, and price earning ratio the price upon earnings. So if we can measure 1 upon earnings upon price. So earning upon price, this is actually the K. This is actually the so price earning ratio inverse of cost of equity. Earnings upon price. So this earnings upon price can be written as K. So this is actually 1 upon K. Or it can also be written as 1 upon earnings into price or price upon earnings. So P is equal to price upon earnings or 1 upon earning upon price, which is actually K. So it can be used as a reciprocal of the cost of equity. Or in this case, it is not taken as cost of equity, it is taken as a minimum required rate of return because we are following the earning based approach. So it can be taken as 1 upon K, minimum required rate of return, or it can be taken as 1 upon ROE. As I have explained that in case of this earning based approach, this ROE, return on equity, and the K, that is minimum required rate of return, can be taken as interchangeably because of the EPS portion. Because the investor is expecting that whatever EPS, whatever the earnings the company is retaining, is investing in profitable growth opportunities, and that return will be available to it, and the present value of that return is calculated. So that retention amount is basically return on equity, because that retention amount or retained portion is actually invested in the profitable growth opportunity. So this way you can interpret that. I hope it is clear now why this inverse of cost of equity is taken, that P is equal to 1 upon ROE or 1 upon K, and why this in this earning based approach that K and ROE can be used interchangeably. Now come to this the last aspect of this, that is the earning growth model. We have to also calculate it with the help of the earning growth model, because we have only taken the price earning approach. Let us calculate it by the earning growth approach. earnings growth approach. In this case, P0 will be EPS will be taken, because in earning based approach it is assumed that the future EPS, present value of future EPS is taken. So it will be EPS into 1 plus G upon K minus G. EPS, we have already calculated the EPS amount, which is actually given 2.25. It is given in the question. 2.25 multiplied by 1 plus growth rate is 2% divided by KE minus G. KE, that is the discounting factor, in this case is 9%. K is taken as 9%, as I have already explained. That is return on equity, and the KE, that is minimum required rate of return, can be used interchangeably in the case of earning based model. That is why discount rate is not taken as 10.5%, it is taken as 9%. That is return on equity is taken as the cost of capital in minimum required rate of return, or the discount rate in this particular case in the earning based approach. Growth rate 2%. Now, let us calculate it. I think it is coming to 32.79. 32.79, as well as on the basis of earning growth approach. So how this earning growth approach is calculated? We applied the formula, that is P0 is equal to EPS. Since it is earning growth approach, we have not taken the dividend amount, we have taken the EPS. It is given in the question also. So EPS into 1 plus G upon K minus G. EPS 2.25, growth rate is 2%. And the important thing to note is that the discount rate is used is 9% and not 10.5%. The discount rate is used as 9% because, as I have already explained, that in this earning based approach, the return on equity and the K, that is the minimum required rate of return which the investor is expecting, can be used interchangeably. That is why discount rate is taken as the 0.9%. We put the figures into the formula. We arrived at 2.295 upon 0.07. That is 32.79. The answer is 32.79 as per the earning growth approach. Fine. So any question on this, guys? Because along with solving this question, I have tried to clear some of your concepts or some of the portion in which you can experience doubt. Okay. Any question? Shall I move forward? Okay, fine. So let us move forward to the next question. Now, first go through the third question and try to understand it, and then we will solve it. MNP Limited has declared and paid annual dividend of 4 per share. Fine. So it is expected to grow at 20% for next 2 years and 10% thereafter. Okay, now you will observe that this is a two-stage growth model. I have taken one example also. that the company is growing, the investor is expecting that the company will grow at exponentially or extraordinary high growth rate for the first 2 years at 20%, and then it will settle to 10% thereafter, means till infinity or perpetuity. And the required rate of return of investor, that is the KE or the discount rate which will be used, is 15%. So you have to compute the current price at which equity shares should sell. So you have to calculate the present value, or present value can also be taken at the price, that is as the minimum price, or you can say at the maximum price which the investor is willing to pay. So let us put the figures into the formula we have, and it will be the calculation of the two-stage growth model. So let us try to solve this. In this two-stage discount model, we will first calculate it for the first 2 years, and then we will apply the perpetuity formula, because after 2 years it is assumed that the company will grow at 5% till infinity. So first calculate it at the 2%, at the first 2 years at the rate of 20%. Or I will take it here only so that you can see it more clearly. Let us take this question. End of year dividend, present value factor at discount rate is 15%. Present value factor at 15% and the present value. For first 2 years, first year, second year. So at the end of the first year, what will be the dividend? The current dividend or the present dividend which the company has declared, MNP Limited has declared, is 4 rupees. So 4 rupees, we have to multiply it by the growth rate, which is 20%. So first year it will be 4 into 1.20. So it will come to 4 into 1.2, that is 4.8. And this dividend at the end of the second year will be the dividend of the first year multiplied by the growth rate, which is 20% also in the second year. So it will be 4.8 into 1.2 multiplied by the growth rate. So 4.8 into 1.2 is coming to 5.76. Then we got the dividend at the end of first year, we got the dividend at the end of the second year. We will then multiply it by the present value factor to arrive at the present value, that is present value of the dividend, that is the present value at the beginning of the first year, the dividend which has been received at the end of the first year and at the end of the second year. Now what is the present value factor? Present value factor is given in the question. Let us apply it. 0.86, 96 and 0.7561. Let us multiply the dividend with the present value factor. It's coming to 4.17 and 5.76 multiplied by the present value factor of second year, 0.7561. So it is coming to 4.36. It is coming to 4.36. Let us add these two figures. Present value of first year and the present value of second year. It's coming to 8.53. So what is this 8.53? 8.53 is the present value of at, you can say the present value at 20% growth rate. It is a 20% growth rate. This is for the first 2 years. Now, the growth rate changes from third year. It is now 10% and not 20%. Now listen to me very carefully. We will take the present value at the end of the second year or the beginning of the third year. This is taken as P2 because I explained it during our discussion in the previous lecture. That is, P0 is taken as present value at the beginning of first year. P1 present value at the beginning of second year, and P2 will be the present value at the beginning of the third year or present value at the end of the second year. It will be present value at the beginning of the third year will be present dividend at the end of the second year multiplied by the growth rate. Then it will come to dividend at the end of the third year upon K minus G. Just wait for a second. Okay. Now, the dividend for the second year we have calculated 5.76. 5.76 multiplied by 1 plus. Now the growth rate is not 20%, it is 10%. 1 plus 0.1 divided by KE minus G. The cost of capital is actually given in the question, which is 13%, which is actually 15%. So it will be 0.515 minus the growth rate, which is 10%. Okay. So let us solve this. 0.76 multiplied by the growth rate is 6.336 divided by 0.05. So it is actually coming to 126.72. So it is the present value at the start of the third year, this 126.72. But we have to arrive at the present value at the beginning of the first year. So the present value at 10% growth rate. Present value at 10% growth rate is 126.72. That is present value at the beginning of the third year multiplied by the present value factor at the end of the second year, which is 0.7561. Is coming to 95.81. So we have calculated the present value at 10% discount rate, which is actually the stable growth rate, normal growth rate, and the present value at extraordinary high rate, that is 20%. So we'll add both these. So we calculate the final present value at both the 20% growth rate, high growth rate, and the 10% normal growth rate. Let us add this present value at 20% growth rate and the present value at the 10% growth rate. So it will be 8.53 plus 126.72. So it's actually coming to 135.25. So it is coming to 135.25. Actually, this has to multiply add by this, not 126.2. I apologize. That is 8.53 plus 95.81. So we'll add both these figures. 8.53 plus 95.81. So 104.34. This is the answer. 104.3. So please check that the present value, final present value which is coming is 104.34 or not. So in this question, how we have proceeded? We have first calculated the present value 20% growth rate. So first of all, we calculated the dividend amount at the end of the first year by multiplying the present dividend with the extraordinary growth rate, which is actually 20%. So we multiplied it by 1.2, which is 4.8. This is dividend at the end of the first year. Then we calculate the dividend at the end of the second year, which is dividend at the end of the first year multiplied by the growth rate, which is 20%, 5.76. Then we multiplied it by the present value factor at the rate of 15%, and this is the present value of the first 2 years. Final present value at 20% growth rate is 8.53. Then we calculate come to the second growth rate, that is 5%, which is P2 is equal to D2 into 1 plus G upon K minus G. This is the price at the beginning of the third year. This P2 is also called the start of, this P2 is also can be called the start of normal growth rate period. The start of normal growth rate, or the end of the super growth rate, or end of super growth rate. And it can also be sometimes called as the terminal value, is also sometimes called as the terminal value. So if in some solution terminal value is used, don't get confused, it actually means the start of the normal growth rate period, that is 5% in this case, or the end of the super growth rate period, that is the 10% in this case, and end of the super growth rate period, which is actually the 20% in this particular question. So we have taken P2, which is the beginning of the third year. We applied the formula, that is dividend at the end of the second year multiplied by the growth rate. Now the growth rate changes to 10% and it is not 20%. K minus G, discount factor 15% given, and 10% is the present growth rate. We calculated present value 10% growth rate as 126.72. Then 126.72 is actually the present value at the start of the third year. We have to arrive at present value at the start of the first year. Therefore, this 126.72 has to be multiplied by the present value factor at the end of the second year, which is 0.7561. So this present value at 10% growth rate is 95.81. So we have to add this present value of 20%, 8.53 plus the present value of 10%, that is 95.81. So 8.53 plus 95.81, the final figure which is coming is 104.34. So this is the present value, the final present value. So I hope this is clear to you. Any question in this, in any portion you are not able to understand? $104.34. Okay, great. 95.81 at 10% growth rate. Okay, fine. So I think that most of you will be able to solve this, but how it will be calculated. And this particular, you can say, can be calculated with the help of the formula also, which is given in your study material. So I will try to solve this as per the formula which is given in the study material also. This is the more simple and user-friendly approach, but the calculation on the basis of the formula which is given in the study materials can also be applied. So both this method can be followed. It is as per your convenience. So I will solve this on the basis of the formula. So let us proceed and solve this solution to this third question on the basis of the formula which is given in my presentation slide also, and which is there in the study material also. This is P0 is equal to D0 1 plus G upon 1 plus A plus D0 1 plus G square upon 1 plus A square. This is for first 2 years, because for first 2 years the growth rate is 20%. Then the growth rate changes from 20% to 10%. Plus Pn, it is mentioned in study material. Pn is nothing but the start of the normal growth rate period or end of the super growth rate period, or you can say terminal value also. So Pn in this case can be taken as P2 because it is the start of the normal growth rate period. P2 is actually nothing but the start of the third year where the growth rate changes. 1 plus K square. Then how P2 is calculated? P2 will be calculated with the help of D0 1 plus Gn square 1 plus G2. G1 is the extraordinary growth rate period, which is 20%, and the normal growth rate period is G2, which is 10%, divided by Ke minus G2, that is the normal growth rate period. First of all, we will calculate this portion, this bracketed portion. We will calculate it first. Let us calculate it. D0, that is the current dividend, which is given in your question. The current dividend is actually 4 per share. So it will be 4 into 1 plus the growth rate is 20%, 0.2 divided by 1 plus 0.15. So first year this figure will be this, plus second year 4 is the current dividend, 1 plus growth rate 0.2 square divided by 1 plus 0.15 square. So let us calculate this bracketed portion first. So it is basically coming to 4. If we solve it, 4.17 plus 4.15 636 is equal to 8.53. So this portion, if we solve it, you can take some time to solve it. This portion plus this portion, it is coming to 4.17 plus 4.36, that is 8.53. So 8.53 is the present value for the extraordinary growth rate period, which is 20%. This portion, the bracketed portion. Fine. Now we proceed further and calculate the value of P2. Let us put the figures into the formula. Current dividend 4, 1 plus G1, that is the higher growth rate, square multiplied by 1 plus G2, which is the normal growth rate, 10%, divided by KE minus G2. KE is the discount rate, 15% minus G2, the normal growth rate. Let us solve this P2 portion. Is coming to 5.76. So 5.76 multiplied by 1.1. So 6.366. 336 upon 0.5 minus this point 0.05. So 126.72. 126.72 is the P2. Now we will calculate this, employ the figure in this complete formula. So P0 is equal to, this portion we have, bracketed portion we have already calculated. The bracketed portion, the figure is 8.53. This is 8.53, that is, it is the P0, a present value at 20% growth rate. So 8.53 plus this portion, P2 upon 1 plus K square. What is P2? P2 we have calculated, 126.72. 126.72 divided by 1 plus K square. 1 plus K. K is the cost of equity, 0.15 square. Let us calculate it. 8.53 plus 95.82. It's coming to 95.82. So 8.53 plus 95.82. It's coming to 104.35. So it is almost same as in comparison to the previous method. The final present value which is coming is 104.35. Okay. Any question on this? P2 is equal to 126.72 and 4.35 P0. Okay, Dev, great. Fine. I hope the rest of you are also getting the same answer. I will once again brief that how we have proceeded in this solving this particular question. This particular you can say formula for the two-stage model is given in your study material. I have just solved it on the basis of whatever formula is given in the study. This portion. So we have segregated it. First we calculated on the basis of this bracketed portion, and then we calculated this P2, and then we put the figures into the final formula. So bracketed portion is calculated by this formula is current dividend 4. This is the extraordinary or super growth rate 20%. For the second year also we calculated by this method. On the base this bracketed portion, the answer is coming to 8.53. 8.53 is actually the growth rate at present value at 20% growth rate, the super growth rate. Now we calculated the P2 on the basis of this formula. So this is 4 is the current dividend, 1 plus G1. G1 is the high growth rate period, that is 20%. So this is square plus G2. G2 is the normal growth rate period, which is 10%. So we applied the formula and got P2 as 126.72. Then we got this bracketed portion, we got this P2, and then we will put the figures into this entire formula, the final formula. So it will be P0 is equal to 8.53. This bracketed portion, the answer is 8.53. That is present value at 20% growth rate. And then we added with P2 upon 1 plus K square. That is P2. We have calculated the figure of P2. That is the price at the beginning of the third year, which is 126.72. 126.72 divided by 1 plus K. That is 1 plus 15% discount rate square. So 8.53 plus 95.882, the final figure which is coming is 104.35, which is the present value. So I have calculated this the two-stage model, the question number 3, on the basis of the first approach and the second approach, the formula-based approach. Both this approach can be used. The first approach is basically you have observed that it is simpler and user-friendly, but you can calculate it on the basis of the second method also. So I would urge you to practice on both these methods, and whichever method suits you, you can apply it in the examination. Okay, any question, any doubt in this particular question? Question number 3. So, any question? I will wait for another 1 minute. Okay, so are we good to go? Fine. So, now let us move to the next question. Okay. This is question number 4. Okay, go through this question number 4 and try to understand it, and then we will proceed. Now, X Limited, which is declared a dividend of 14. X Limited has declared a dividend of 14, which is the present dividend. And Mr. B, as an investor, wants to purchase the shares of X Limited. Fine. And it anticipates that the growth rate will increase from 8% to 9%. So, future growth rate will be taken as 9% while calculating, which will continue for 3 years. And then Mr. B is planning to sell it after 3 years, because it is given in the question that he expects the market price of this share to be 360 after 3 years. And in the first, let us take the first situation initially, that you have to determine the maximum amount which Mr. B should pay for shares if he requires a rate of return of 13% per annum. Fine. So if you observe this question, Mr. B is actually wants to hold the share for 3 years only. So we have to calculate it for 3 years. So let us determine this and try to solve this question by taking the first method only. I'm stop sharing it and going to the whiteboard. Actually, in this method, the perpetuity formula will not be applicable because it is assumed that the investor is actually holding it for the first 3 years. So, dividend for first present value of dividend which is receiving up to next 3 years, and the price, that is the selling price he will be receiving after 3 years, the present value of that portion will also be calculated. So, let us see how we will proceed in this particular question. Now question number 4, the first portion. End of the year, dividend, present value 13%, present value factor is given, present value factor at the rate 13%, and then present value. So end of the first year, second year, third year. And dividend is, present dividend is 4, present dividend is actually 14, and it is growing at about 9%. Okay. So first year it will be 14 into 1.09. So let us calculate it. 14 multiplied by 1.09, it is multiplied by the growth rate, 15.26, the dividend at the end of the first year, and dividend at the end of the second year will be dividend at the end of the first year multiplied by the growth rate. So 15.26 multiplied by 1.09. See, it is 16.63. Now dividend at the end of the second year will be multiplied by the growth rate. 16.63 multiplied by 1.09. It's coming to 18.13. And then we will multiply it by the present value factor at 13%. It is actually given in your question. For first year it is 0.885, for second year it is 0.783, and for the third year it is 0.693. Okay. So let us calculate it. First 15.26 multiplied by 0.885. It's coming to 13.50. Then dividend at the end of second year, 16.63 will be multiplied by the present value factor, 0.783. That is 13.02. Again, dividend at the end of the third year will be multiplied by the present value factor, 18.13 multiplied by 0.693 is 12.56. And again, the price which will be available at the end of the 3 years, the present value of that price also have to be calculated. What is the price? The price is 360. The price is 360, which will be available at 3 years. Means after 3 years, Mr. B is planning to sell it at 360. So dividend oblique price, you can write it down. And the present value factor at this third year will be applicable 0.693. So let us find it. 360 multiplied by the present value factor of third year, that is 0.693. is coming to 249.48. Let us add all these figures, present value of all the years. Coming to 288.56. It is coming to about 288.56. So please check at your end whether the answer is coming or not, the first part. Okay. So how we have proceeded? In this question, the first part it is given that Mr. B is planning to hold the shares for up to 3 years. So dividend for all the years, dividend received at the end of all the years will be multiplied by the present value factor, which is 13%. And he's also expecting to sell the shares at the end of 3 years at rupees 360. So 360 he is receiving at the end of the 3 years. The present value of this amount also have to be calculated. So 360 is multiplied by the present value factor of third year at the end of the third year at the rate 13%, which is 0.693. So this figure is arrived at 249.48. So the present value of dividend of all the years plus the present value of the sales price will be added, and this is actually the present value at the end of 3 years. That is present value at the that is the present value which the company is holding for, which the investor is holding the shares for 3 years. Fine. To 88.57 to 88.56. Okay, they will find. To 88.56. Okay, then fine. Now let us take the second aspect of the question. Now read this, the second part, which is showing that the maximum price Mr. B will be willing to pay if he is of the opinion that 9% growth rate can be maintained indefinitely and the required rate of return is 13%. So in this case, it is clearly mentioned that the 9% growth rate will be maintained indefinitely or till perpetuity or for a very long time. So the KE minus D1 upon KE minus formula can be safely used in this particular case. So this second question is comparatively easier to solve. So let us solve this, the second part of this question number 4. Okay, we can continue here also. Fine. So in this case, since it is assumed that the 5%, that is the 9% growth rate will be achieved till infinity. So this particular formula, that is D1 upon K minus G or D0 into 1 plus G upon K minus G formula can be safely used. Now, what is the dividend? What is the current dividend? The present dividend 14 multiplied by 1 plus G, that is the growth rate. Growth rate is 9%. Divided by K minus G. K is the discount factor minus growth rate, that is 9%. So 14 is the current dividend. 14 is the current dividend. 9 is the growth rate. And 13 is the discount rate. So 15.26 multiplied by 0.03 minus 0.09, it is 0.04. Let us solve this. 15.26 divided by 0.04. It is coming to 381.5. So check it. 381 for 0.5 is the answer. I think it is correct. So second part is relatively easier. You simply apply the KE minus G formula, and this formula is generally applicable where it is assumed that the company will pay dividend at a certain growth rate till infinity, till perpetuity, or for a very long time. Fine. Now, shall I come to the third aspect? I think let us come to the third portion. Now, the third part of this question number 4 is telling that the price of the share at the end of 3 years, if 9% growth rate is achieved, 9% growth rate is achieved, and assuming other conditions remaining same as in 2 above. So price, what you have to calculate. This you have to listen, or you have to read this question very carefully. This part especially, price of share at the end of 3 years. It means P price at the end of the 3 years or at the beginning of the 4th year. It will be P3. You have to calculate P3, or you have to calculate the terminal value in this case. That is it is the end of the super growth rate period, and this is the start of this. So you have to calculate this P3, that is terminal value in this case, and all of the conditions are same, means 9% growth rate, and the formula which will be used is this growth rate of 9% will be maintained indefinitely or till perpetuity. Sairam is asking, what about only D1 formula? D1 formula is different. Sairam, can you please clarify your question? I'm not getting your question properly, because what I've understood is, yes, D1 can be written as D0 into 1 plus G, or it can be written as D1. But if you please clarify your question, then I will be able to answer it. In the meantime, let us get to the third part of this question number 4 and try to solve it. We have to, I hope you have understood it, that all the conditions are same. That is, it is assuming that the growth rate of 9% will be maintained indefinitely, and you have to calculate price at the end of 3 years or the beginning of the 4th year, which is P3. So you have to calculate P3 in this case. Now let us solve it. I will stop sharing it. So let us come to the third part. So P3, price at the beginning of the 4th year, is actually the dividend at the end of the 3rd year multiplied by the growth rate upon KE minus G, because it has been assumed that 9% growth rate will be achieved, will be followed indefinitely. So now what is the D3 we have calculated? I think the D3 figure which has been calculated is, this question number 4 is 12.56. 18. 18.13 is the dividend at the end of the third year. We have calculated it 18.13, 1 plus the growth rate, which is actually 9%, divided by KE minus G, that is the discount rate, which is 13%, minus the growth rate. Okay, so D3 into 1 plus G upon KE minus G. D3 is 18.13, which is dividend at the end of the third year. We multiplied it by the growth rate 9% to arrive at the dividend at the end of the fourth year, because we are calculating present value at the beginning of the fourth year. So we will take dividend at the end of the fourth year divided by KE minus G. Cost of capital is 13% given in the question. Growth rate 9%, which is also given in the question. So let us calculate it. 18.13 multiplied by 1.09 is 19.76 divided by 0.04. I think it is coming to 494. 494. The third part of question number 4. 494 is the answer to this third part. Okay. Any question on this? How we have proceeded in this question? $494.04. Okay, very great. So all of you are getting the same answer. So I hope that it is clear, this question number 4. We'll wait for a few more moments for any questions to emerge. Otherwise, I hope it is more or less clear, all the aspect. Okay, then great. 494.04. So most of you are able to now getting the current answer and have a grasp of the concept. So it is now about 8:28, 8:29. Let us take a brief break of about 10 minutes and come back at about 8:40. So let us meet at about 8:40. Okay. So we have taken the first 4 questions of this valuation of equity shares. Let us proceed further. Okay, this is the 5th question, and you have to calculate the value of shares from the following information. Now, this question you have to read it very carefully in order to understand that how to proceed with this question. Let us see what is given in this particular question. The profit of the company is given, which is 290 crores, fine, equity capital, par value of shares, and debt equity ratio is given 27%. So if debt is 27%, it means equity is 73%. And growth rate of the company is given 8%. Another thing to notice in this particular question is beta is given, risk-free rate of interest is given, and market return is also given. It means the cost of equity, if you notice, that is not given. The discount rate is not given. So in this case, the discount rate has to be calculated with the help of the CAPM model, because whatever figures are there, beta, risk-free rate, and market returns are applicable to the CAPM model. Now, capital expenditure per share given, depreciation per share given, changes in working capital given. So from all these figures, you can deduce that this question cannot be calculated with the help of the dividend discount model or the earning based model. It can be safely assumed that this question can be calculated with the help of the free cash flow to equity module. Various you can say figures are given: capital expenditure, depreciation, change in working capital. But these are, if you notice another thing, that all these figures are given on per share basis, and profit of the figure, that is profit of the company, is a complete figure, entire figure is given. So from the profit of the company, we have to calculate the EPS first. Okay, so let us calculate the EPS first, then we will calculate the free cash flow, then we calculate the present value of the free cash flow. So we will proceed in this sequential steps. So let us try to solve this question. Question number 5. So in this case, first of all, we have to calculate the EPS, because figure of EPS is not given. Why we are taking EPS? Because other figure, that is capital expenditure, depreciation, and change in working capital, are given on per share basis. So it will be easier to solve this question if we calculate the earnings or the profit on per share basis. So profit of the company is given. So EPS, what is the formula? EPS is equal to profit, that is net profit after tax, divided by the number of equity shares. The number of equity shares. The net profit figure is given 290 crore, rupees 290 crore, and the number of equity shares is not given. You have to calculate it on the basis of the figures which are given. So number of equity shares will be the total equity capital, which is 1,300, and the par value, which is 40. So it is 1,300 total value divided by the par value, that is rupees 40 per share. So the number of equity shares are 1,300 divided by 40 is coming to 32.5. Is coming to 32.5 shares, or you can say 32,50,000 shares. 32,50,000 shares. Okay. Now we can calculate the EPS because we have got the number of shares. So we will divide 290 crores profit after tax upon 32.5, which is the number of shares. So 290 crore divided by 32,50,000. Let us see. 290 divided by 32.5 is coming to 8.92. 8.92 is the EPS, that is 8 lakh earning per share, that is 8.92 is actually the earning per share. Well, 8.92, it is better to take it 8.923 at about 3 places. Fine. So we've got the EPS. Now we can calculate the free cash flow to equity. Free cash flow to equity. Free cash flow to equity, that is net profit and depreciation amount is adjusted, any capital expenditure is deducted, and any change in net working capital is also deducted. All these figures are given in your question. But the first thing to notice in this particular question is that the debt equity ratio is 27%. So 1 minus debt equity ratio, debt, that is debt upon equity. If debt is 27%, then equity is 73%. Since this cash flow is available to the equity shareholders, we can calculate all these amounts on the basis of the percentage of the equity, that is 73%. Okay. Now let us see how we calculate it. First, we take the profit figure 2.923 earning per share plus we add the depreciation. Depreciation per share is given 39, but it has to be calculated on the percentage of the equity, which is 73%. 0.73 multiplied by 39. And any capital expenditure have to be deducted. Capital expenditure given in the question is 47. This has also to be calculated in proportion to the equity. Again, the change in net working capital is given. This again has to be calculated in proportion to equity. So 0.73 multiplied by 3.45. So let us calculate what is the final figure. 8.923 plus, let us calculate this depreciation first. 0.73 multiplied by 39. It's coming to 28.47. Now then calculate the capital expenditure portion, 0.73 to 47. That is 34.31. And deduct the working capital portion also. 0.73 multiplied by 3.45. Multiplied by 3.45. That is 2.5185. 73 multiplied by 3.45 is 2.5185. Fine. Now add or subtract all these figures. Let us calculate it. 8.923 plus 28.47 minus 34.31 minus 2.5185 is coming to 0.56. Is coming to 0.5645. Free cash flow 0.5645. Fine. So, how we have proceeded till now? We calculated the EPS, then we calculated the free cash flow of equity. Now, the question is asking about the value of share, that is present value of shares. So, we have to calculate the present value on the basis of the FCFE or free cash flow to equity. Now, P0 is equal to FCFE, that is free cash flow to equity, multiplied by 1 plus the growth rate, 1 plus G divided by KE minus G. Divided by KE minus G. The FCFE or free cash flow to equity we have calculated. Let us see whether growth rate is given in the question or not. Growth rate is given, that is 0.8%. But if you observe that KE, that is cost of equity, is not given, so you have to calculate the cost of equity. We have to calculate the cost of equity. For the required rate of return, cost of equity KE is equal to, on the basis of CAPM model, because Gordon's model cost of equity cannot be calculated about whatever figure is given. So, cost of equity or the required rate of return or the required rate of return, the expected rate of return is equal to RF plus beta into RM minus RF. So this is actually the formula of the CAPM model. This is the CAPM model. That is the capital assets pricing model. We have solved one small example in the previous lecture also, how this cost of equity and the required rate of return can be calculated with the help of CAPM model, capital asset pricing model. RF plus beta into RM minus RF. So this RF is risk-free rate. This beta shows the volatility, means how volatile the stock of a company in comparison to the market, for example, Nifty or BSE. RM is the market return, for example, what the Nifty is showing as return. RF is the risk-free rate. Now let us put the figures into this formula. The risk-free rate is given in the question. Sorry, and directly take it. Risk-free rate is given 8.7 plus beta. Beta is given in the question. Beta is 0.1. RM is the market rate. RM is given 10.3%. 10.3 minus risk-free rate, which is 8.7%. Now let us calculate it. So it is 8.86. It is the cost of capital is K is 8.86. Now we have got all the figures. Free cash flow to equity, growth rate is given. We have calculated the cost of equity. Now put these figures into the formula. FCFE 0.5645, 0.5645 multiplied by 1 plus growth rate, which is given in the question, 8%, divided by KE minus G. KE we have calculated 8.86. Growth rate is 8%. Now let us calculate it. Now calculate the final figure. It is coming to about 70.89. Is coming to 70.89. So please check if this is the figure 70.89. Yes, Tejanshu, I will share the notes, don't worry. Okay. So, how we have proceeded in this particular question? From the figures, whatever figure is given into the particular question, you can easily deduce that this question has to be calculated with the help of free cash flow to equity method. Dividend discount model and earning based model cannot be employed in this particular question. From the capital expenditure per share, depreciation, change in working capital, you can easily judge. Now, how to proceed? Every figure, that is capital expenditure per share, depreciation per share, change in working capital, every figure is given in on per share basis, but the profit of the company is given in the entire value. So we have to calculate the EPS first, that is earning per share. Earning per share is not given, so this formula we have applied, net profit after tax upon number of equity shares. Net profit figure 290 is given in the question, but number of equity shares is not given. So it is calculated with the help of the whatever figure is given in the question, that is total value of shares, equity capital is 1,300 upon the per share amount 40. So number of equity shares is 32.5, that is 32 lakh 50,000. So net profit 290 crore divided by 32 lakh 50,000, we get the EPS 8.923. Now we got the EPS, we calculate the FCFE or free cash flow to equity, which is the EPS amount 8.923 plus 0.73. Why 0.73? Because it is the cash flow which is available to the equity shareholder. Therefore, the percentage of equity has to be taken. What is the percentage of equity? Debt equity ratio is 27%. So if debt is 27, then the equity will be 73. So every figure has to be calculated in the proportion of 73%. So 0.73 depreciation is added back. So 0.73 plus 39. This is the depreciation per share. Then capital expenditure is deducted, as we have seen during our examples in FCFE, minus 0.73 equity percentage into 47 capital expenditure. Then again the working capital is deducted, equity percentage 0.73 into 3.45, which is the working capital per share. We add, then we calculate all this figure, and the final figure we got is 0.5645, which is the free cash flow to equity. Now, once we got the free cash flow to equity, we have to calculate the present value also. So, free cash flow to equity, FCFE, multiplied by the growth rate divided by cost of equity minus the growth rate. FCFE, we have got growth rate is given in the question, but cost of equity is not given in the question. Cost of equity, you have to calculate it. In this question, cost of equity cannot be calculated on the basis of Gordon's model. The cost of equity can only be calculated on the basis of the CAPM model, that is capital asset pricing model. Because whatever figures are given, it can be easily deduced that the CAPM model has to be employed. The risk-free rate, beta, and the market rate, all figures are given in the question. You have to put the figures into the formula, and the cost of equity or the required rate of return as per the CAPM model is 8.86. Now you have got all this, you have got the FCFE, growth rate is given, you got the cost of equity, you put these figures into the formula and got the present value of the equity shares or the intrinsic value, which is the 70.89. 70.89, 70.90. Okay, Yatin, great. I hope the rest of you are also getting the same answer. Any doubt or any question you can please ask. Okay, any other question? Otherwise, I will proceed further. Fine. So let us move forward to the next question. Now come to question number 6. In question number 6, various figures are given. That is 8% debenture is given, bonds are given, equity share capital is given, reserves and surplus, total assets turnover, effective rate, interest rate, effective tax rate, operating margin, dividend payout ratio, current market price, and required rate of return. These figures are given in the question. First of all, you are required to draw income statement. You have to calculate the income statement. Then you have to calculate the growth rate. Then you have to calculate the present value, that is the fair price of the company. And then you have to give your opinion that whether to purchase the shares of that particular company or not. So how will you proceed? First, you have to calculate the income statement. But income statement, you have to proceed with the sales figure. In the particular question, if you observe that the sales figure is not given, but sales can be calculated with the help of the asset turnover ratio, because asset turnover ratio and total assets both are given. So on the basis of these two figures, the sales can be easily calculated. Sales can be easily calculated and the operating margin is also given. So this is percentage of sales. So on this basis, cost of goods sold can also be calculated on the basis of sales minus this operating margin figure. And then we can calculate the interest rate, and so on. So this way the income statement can be calculated. So first of all, let us calculate the income statement and then proceed further. That is through the sustainable growth rate and the present value, and then the decision that whether you will be purchasing the stock of that particular company or not. I'm stop sharing it and let us solve this question. Okay, Deborah. This first two parts of the question has been already been solved. That is good. But for the clarity of all the students, and in order to solve the question in its entirety, let us begin with the first and second part also. Okay. So let us calculate the income statement. Certain figures have to be calculated, that is, the sales have to be calculated first. So you can, working notes can give. So sales figure is not given, it can be calculated with the help of the asset turnover ratio and the total assets. Asset turnover ratio is given. It is 1:1. So asset turnover ratio is basically sales upon assets, which is actually 1.1. So sales is 1.1 time of assets. Since the total assets are given, total assets are 600 lakhs. So total sales will be 600 lakh into 1.1. 600 into 1.1, it will be 660 lakhs. It will be 660 lakhs. Okay. So asset turnover, sales upon asset, 1:1. Since total asset is given 600 lakh, therefore total sales will be 600 into 1.1, because sales is 1.1 times of asset. So it will be 660 lakhs. So one figure is arrived at, sales. What next? Operating margin. Operating margin is given. It is 10% of sales. Sales figure is arrived at 660 into 10%. That is 66. That is 66. So this operating margin figure is also calculated, 10% of sales, which is given in the question. Now, on this basis, you can calculate the cost of goods sold. COGS can be calculated. That is sales minus this operating margin, which is 660 minus 66. 660 minus 66. I think it is actually 594. 660 minus 66, which is coming to 594. 594 lakhs. So this is the cost of capital sold. Cost of goods sold, how it is calculated? Sales minus operating margin. Sales 660 minus 66. The operating margin we have calculated. So 594 is the COGS. Now the interest amount is also very important. You have to pay close attention to this particular aspect, because effective interest rate is given. If effective interest rate is given, you have to calculate the entire interest on 8% only, and not the interest rate which are given separately. For example, if effective interest rate is not given in the question, you can calculate it 8% in debentures, that is 8% on 125, or 10% on bond, that is 10% on rupees, 10% on 50 lakhs. But since effective rate is interest, effective interest rate is given, you have to calculate the figures of bonds and debentures at 8% only. So see how the interest will be calculated. Interest is equal to debenture plus bond. Debenture 125, debenture 125 plus bonds 50, bonds 50 multiplied by the 8% interest rate, since effective interest rate is given. So it will be 175 multiplied by 8%. So 175 into 8%. It is 14. So interest is coming to 14. Now we have more or less get all some of the figures, that is sales, operating margin, COGS, and the interest rate. So now the income statement can be easily calculated from these figures. So sales 660 less cost of goods sold, we have calculated 594 lakhs. 594 less the amount will be operating margin. It is actually 66. Actually 66, we have calculated it. Operating margin 66. We deduct interest. Interest at the rate 8%, because effective interest rate is given. We have calculated the amount 14. So 66 less 14. So it is coming to 52. So 52 is the earning before tax. From this we deduct the tax. Tax rate is given in the question, it is 40%. Less tax at the rate 40%. So 52. So 52 into 40%. 20.8. So 52 minus 20.8, it is 31.2. So 31.2 is the earning after tax. From this we will deduct the dividend. It is given in the question that dividend payout ratio is 16.67. The dividend payout ratio is 16.67%. So dividend paid will be deducted. So this 31.2 into 16.67%. Coming to about 5.2. So final amount 31.2 minus 5.2, that is 26. So 26 is the retained earnings. 26 is the retained earnings. So this is the income statement. I hope it is now clear to you. This is income statement and how we have proceeded, because I proceeded very slowly, that so that you can understand this concept very well. Now come to the second aspect of the question, The second aspect of the question is asking about the calculate the sustainable growth rate. You have to calculate the sustainable growth rate. I hope you by now you have copied it, understood it fully. So I'm rubbing it, the next portion, working notes portion. Now, sustainable growth rate. So, how growth rate is generally calculated? B into R. P into R, that is retention ratio multiplied by return on equity or return on retained earning. We explained that how this return on equity and this return on retained earnings can be used interchangeably. So retention ratio into return on equity. Now let us see whether these figures are given in the question or not. We have to see. Retention ratio, whether it is given. Retention ratio can be made out because if dividend payout ratio is 16.67, it means that the retention ratio is 100 minus 16.67, it is coming to actually 83.33. So 83.33% is the retention ratio, means that much amount company is retaining and investing in the profitable growth opportunity. This is the retention ratio. And return on equity means whatever percentage of retention the company is investing, whatever return it is generating, it is the return on equity. So that is why it is the growth rate, retention ratio, whatever amount the company is retaining, and whatever return the company is generating out of that.
Mr. Vivek?
Yes, sir.
Actually, this sustainable growth part I have already discussed in the class.
Okay, fine. So I will calculate it just very quickly, so that
because I have already covered sustainable growth rate in very detail. Okay. You so, basically just calculate the fair price of the company, share price of the company.
Fine. So I will calculate it very quickly. That is the retention ratio, return on equity. So retention ratio, it is given in the question, is actually 83.33%, and return on equity can be calculated with the figures which have been given in the question. That is, it is profit after tax upon equity into 100. So profit after tax we have calculated 31.2. So 31.2 divided by the equity. Equity is given into the question also. Question, that is equity shares plus reserves and surplus. Equity shares is 100, reserves and surplus is 300. So it is actually 400. So equity is 400 multiplied by 100. So it is 31.2 multiplied by 400 into 100. It is actually coming to 7.8. Now we have got the retention ratio, we have got the return on equity. Let us calculate it. 0.883, this is the retention ratio, and multiplied it by the return on equity. It is actually coming to 6.49 or 6.5. So this sustainable growth rate is coming to 6.5%. Okay. Now we have got the income statement, we have got the sustainable growth rate. Now let us get to the next part, that is third part, that is the fair price of the company, or the present value of the company share, and you have to use the dividend discount model. Fine. So present value, that is T0, it will be multiplied with the formula we will use D0 into 1 plus G divided by K minus G. So D0 dividend per share. Now, if you notice that the dividend per share amount is not given because the total dividend amount is given in the income statement. The total dividend amount is actually 5.2, that is 5,20,000. So 5,20,000, you have to divide the 5,20,000 by the number of equity shares. So dividend per share will be calculated as 5,20,000. 5,20,000, this is the total dividend which I have calculated in the income statement upon number of equity shares. Number of equity shares, it is given in the question also, that is 100 upon 10. So it is 100 upon 10. So it is actually 100 lakh upon 10. That is actually 10 lakh. So number of equity shares is 10 lakh. It is given in the question also. So 5,20,000 upon 10 lakh. It is 0.52. So dividend per share is 0.52. Now put the figures into this formula. D0 0.52, 1 plus growth rate. Growth rate we have calculated, that is 6.5 upon K minus G, cost of equity. Cost of equity is given in the question. It is 15% minus G, growth rate 0.065. Now let us calculate this amount, final amount. Is coming to about 6.52. 6.52 is the present value of equity share. This is the present value of equity shares. Okay, this is G, 6.5. So 6.52 is the answer. I hope most of you are getting this answer, 6.52. So how we have calculated? We employ the Gordon's simple formula, D0 into 1 plus G upon K minus G. Dividend per share is not given. We first calculated the dividend per share. Total dividend is given. While calculating, we have reduced the total dividend by calculating the income statement. 5,20,000 was the total dividend divided by the number of equity shares. We get dividend per share 0.52. We put this figure into the formula, 0.52 into 1 plus growth rate. Growth rate we have calculated 6.5%, and K, that is cost of equity or the required rate of return or the discount rate, is given in the question, 15% less growth rate. So the figure we got is 6.52. It is the present value of the equity shares. Fine. Now get to the last point. What is the last point is asking? Last point is asking about your opinion on the investment on the company shares, whether to invest in the shares of that particular company or not. For this purpose, as we have discussed during our discussions on fundamental analysis and also in our previous lecture, that this market price, that is the present value of equity shares, which is also called the intrinsic value, has to be compared with the current market price in order to arrive at a decision whether to purchase the shares of the company or not, whether to invest in the company shares or not. Let us see. In this case, the intrinsic value or you can say the present value is greater than the market price, or it is greater than the, or it is less than the market price. Current market price of the share is given 14. So intrinsic value is 6.52. 6.52 is less than the current market price. So it is actually less than the current market price. Intrinsic value was less than the current market price. So this 6.52 is actually less than the 14 rupees which is given in the question. So what will be your decision? If intrinsic value is less than the current market price per share, or the current market price is greater than the intrinsic value, it means that the company is overvalued. It means the company is overvalued, or the decision will be not to invest. The decision will be not to invest. The decision will be not to invest. So I hope you have got the concept that when the intrinsic value is greater than the current market price, the decision, it is generally concluded that the company is undervalued and it is better to purchase the shares of the company. On the other hand, if the intrinsic value is less than the current market price, it means that the company is overvalued and it is better not to invest in that particular company. The reason is that the future prices, it is a very likely opportunity that in future the prices, the market price of the share will not raise beyond 6.5 because it is the present value of future cash flows. So, and this is the maximum price which the investor is actually willing to spend, because the current market price will ultimately, it is assumed that the current market price is ultimately calculated, or this you can say reflected in this intrinsic value. So in future there is very 6.5. Okay, presently the value is 14. It means it is overvalued. So if you're holding it, is better to sell it or not to invest it. So this is what the basic concept in this case. So I have calculated all the aspect. Any aspect in which you find it not able to understand, you can please ask. Yes, this 6.52 per share is overvalued and it is better to sell. Okay, any other question which is coming to your mind? I will wait for 2 minutes. So you can see that the particular question, we have taken various types of question in which question has been solved with the help of dividend discount model, earning based model, free cash flow. In this aspect, you can say all your concept will be clear. First of all, you have to prepare the income statement, then the growth rate. After getting all the figures, you then calculated the present value with the help of the dividend discount model. And then we arrive at a decision whether to invest in the company shares or not. So this is basically a complete question in which all your concept will be clear. So if you have no more queries, if you understood it, I hope you have understood this question fully. Let us get to the next question. Okay. So Sairam is asking that if the price of share increases, then what will be the advice? If the price of share increase, means the you can say intrinsic value is more. The price of share, you want to say that price of share is increased. it means that the intrinsic value is more, then it will be better to invest in the shares of the particular company. I will take an example. For example, intrinsic value is greater than the current market price. Intrinsic value is greater than the current market price or the present value. Let us take a hypothetical figure, an assumed figure. Say intrinsic value is 100. Okay. And the current market price per share is 110. Intrinsic value is 110. And the current market price is 100. In this situation, what is the basic concept of this intrinsic value? The basic concept of this intrinsic value is that it is the present value of future cash flows, or it is the value, maximum value, which the investor is willing to pay at present. Why? What is the reason? The reason is that there is every possibility that in future the market price will increase or will reach to 110, and there is very little chance that the market price will actually move beyond 110. It can move below 110, but it is very little chance that it will move beyond 110. Currently, the market price is 100. Intrinsic value is 110. So, as per the concept explained to you, there is every chance that the investor will be able to pocket at least 10 rupees. If he purchases at 100, then he is hoping that in future it will move to 110 and you can pocket it some profit. So, if you are able to pocket some profit in the future, it is better to invest. It is better to invest. It is better to invest in the stock of that particular company. I hope now it is clear, because in this question I have taken that intrinsic value is less than the current market price on the other hand. So, if the investor is thinking that in future price will not move beyond 6.52. Currently the price is 14. It means it is overvalued. So if the investor purchases at 14, he will not be able to sell it at profit in the future. There is very less chance. So the company is overvalued, and the decision is not to invest in this question. But in this particular situation, if the intrinsic value is greater than the current market price, then yes, it is an undervalued company. It is an undervalued company, and it is better to invest in the shares of that particular company. So I hope now your concept in this case is clear. Okay. Now, shall we move to the next question? I hope it is clear to you, Sairam. Okay, fine. Now, coming to the 7th question. First, let us read this question carefully and then solve it. Take a few minutes to read this question. Fine. So, Mr. A is an investor who is thinking of buying the shares at rupees 500. Face value is 100. Okay. And thinking of buying the shares at 500 means it is the current market price. This 500 is the current market price. And he is expecting a bonus issue 1:5 during the 4th year. Means he is expecting that company will issue bonus shares at 1:5. That is, the company will issue 1 bonus shares for 5 shares held in the 4th year. Annual expected dividend 20% fine, and the same rate is expected to maintain the expanded capital base. For example, by issue of bonus shares, the capital base will be expanded. So 20% growth rate will be applicable on this expanded capital base also after the bonus issue. Now, the investor, that is Mr. A, wants to sell the shares at the end of the 7th year at the price of 900 each. So he wants to hold the share for 7 years only. And at the end of the 7 years, he wants to sell it at 900 each. Now, another aspect in this question is incidental expenses. Incidental expenses for both purchase and sale is 5% of the market price. So you have to consider incidental expenses in case of both purchase of shares and sale of shares. And also he expects a market minimum return of 12% per annum. So this is the minimum required rate of return or the discount rate, which is 12%. Now you have to take a decision as an investor whether you should buy the shares, he should buy the shares or not, and what is the maximum price he should be willing to pay. You have to avoid any tax on dividend income and the capital gain. So first of all, we have to calculate the present value. Then we have to calculate the purchase price. We have to see what is the net gain. And then we will take the decision that whether he should buy the shares or not. And then what the maximum price he should be willing to pay for the shares. Mr. A will be willing to pay. So let us solve this question step by step as I have discussed just now. Okay, fine. So now let us solve this question. End of year. Dividend oblique price. Present value factor. Present value factor, what is the discount rate? It is 12%. Present value factor at the rate 12% and the present value. First year, then second, third, fourth, 5, 6, and 7. Fine. So dividend. So I'll make the capital gain also. Now, let us assume that the investor is holding one share only because it will be now easier to calculate or solve this question properly. Let us say Mr. A is holding one share. So, for one share, his dividend will be rupees 20 because dividend is 20%. So, and face value is 100. So, 20% of 100 it is 20. So, for one share, he is getting dividend at rupees 20. So dividend is rupees 20. And what is the present value factor at the rate of 12%? If you see that the present value factor is not given in the question, you have to calculate it. Present value factor can be easily calculated with the help of the calculator. Most of you must have know that. It will be 1 upon 1 plus 0.12 or 1 upon 1.12. 1 upon 1 plus 12 or 1 upon 1.12. So let us on the calculator 1 upon 1.12. It is actually 893 for the first year. 893 for the second year. Just click on the equal to sign. It's 0.797. For third year, it is 0.712. For fourth year, it is 0.636. For fifth year, it is 0.567. For sixth year, it is 0.507. For seventh year, it is 0.452. Okay. Now, dividend for the first year is 20. So, we will multiply this 20 into 0.893. We will get the present value of dividend, which is at the receiving at the end of the first year, is 17.86. Now, second year also the dividend will be rupees 20 only. So, 20 multiplied by the present value factor 0.797, that is 15.94. In the third year also the dividend is 20. 20 multiplied by the present value factor, that is 0.712. It's 14.24. Now come to dividend for the fourth year. Now we have to pay attention on this. What is given in the question? It is given in the question that the investor is expecting a bonus issue at the ratio of 1:5 during the fourth year. So, if for one share the dividend is 20 rupees, then for, now let us see what will be his shares. If you are, means he is getting one bonus shares for 5 shares. For 5 shares, he is getting 1 share. So, we are assuming in this question that he is holding 1 share. So, for 1 share, it will be 1/5 into 1, it will be 0.2. So, for if 5 shares, he is getting 1 bonus shares. So, in case of 1 share, he will be getting 0.2 share. So, now his total share will be 1 existing share plus 0.2 out of bonus issue. So, total shares will be 1.2. So, for 1 share, the dividend is rupees 20. So, for 1.2 share, shares, his dividend will be 20/1 into, that is 1.2. The 20 into 1.2, it will be 24. It will be rupees 24. So, I will again revise the calculation. For 5 existing shares, 1 bonus shares have to be issued. It is given in the question. So, in this question, we are assuming that the investor is holding 1 share. So, for 1 share, the bonus shares which will be issued is 0.2. So, now after the bonus issues, total shares are 1 existing share plus 0.2 bonus issue. So, 1.2. Previously, he was holding 1 share. 1 share, he was receiving 20 as dividend. So, for 1.2 shares, he will be receiving dividend at 20 into 1.2, that is 24. So, now from 4th year onwards, his dividend will be rupees 24. So, 24, now let us calculate 24 into the present value factor of the 4th year, that is 0.36. 636. Will be 15.6. Again, 5th year, 24 multiplied by the present value of the 5th year. It is 13.61. Now again, dividend for the 6th year will be 24. So 24 into the present value of 6th year, that is 0.507. 24 into 0.507. It is 12.17. For 7th year also, he is receiving dividend at 24. 24 multiplied by the present value factor of the 7th year, 0.452. 24 multiplied by 0.452. That is 10.85. And again, in the final year, he is expected to sell the shares at rupees 900. So it will be 900 into 1.2 shares. Mind you, the shares are now not 1, it is 1.2 after the bonus issue. So 900 rupees into 1.2 into incidental expenses also, because incidental expenses have to be deducted in case of sale of shares. So into, you can say 95% or 0.95. So the amount will be 900 rupees into 1.2 shares into this 95%. So it is coming to 1026. So 1026 multiplied by the present value factor of the 7th year in which it is selling the shares. So it is 463.75. 463.75. So let us add all these figures. Let us add all these figures. So it is coming to 563.68. 563.68. So kindly check at your end only. It's coming to 563.68. It is actually the present value. Actually the present value. $563.68 is the present value. Now, what is the gain? You can calculate the gain by subtracting the acquisition price. Because as an investor, you also want to know that by purchasing the shares, you are likely to gain in the future or not. So this is the purchase price. Less purchase price, which is his purchase price that is given in the question. It is actually 500 rupees 500. So, but again, while purchasing also incidental expenses have to be paid. So rupees 500 plus rupees 500 into, you can say 5%. So purchase price is coming to 500 into 5% is 25. So 500 plus 25 it is actually 500 plus 25. So amount is 525. 525. So what is the net gain? It is present value 563.68 minus 525. Is 38.68. 38.68. So what is this 38.68? It is the net gain. It is the net gain, or you can say it is the capital gain also. Okay, so how we have proceeded in this question? We have assumed that the investor is holding only one share, and then we proceeded sequentially For 7 years, we have calculated the figures because from the question it is given that the investor is holding the shares for 7 years only. So on the first year, the dividend is rupees 20 because for one share, face value is 100. So 20% of 100 is 20. So for first 3 years, the dividend is 20 rupees. We multiply it by the discount factor, which is given, that is 12%. But from the fourth year onwards, the company is expect to issue bonus shares. So bonus shares is actually 1:5. That is, the company will be paying bonus issue at one bonus shares for 5 shares held. So now his total shares will be 1.2 shares, not 1 shares. So if for 1 share the dividend is 20, so for 1.2 shares his dividend will be 24 from 4th year onwards. So we will multiply for 4, 5, 6, 7 all these years by the present value factor at the rate of 12%. Now the thing to pay attention is the 7th year, because 7th year the investor A will be expecting to sell his shares at rupees 900. But now his shares are 1.2. Therefore, 900 into 1.2 shares into 95%. Why? Because the incidental expenses has to be paid at the time of sale of shares. So the total value is coming 1026. This will be received at the end of the 7th year. But we have to arrive at the present value. Therefore, this 1.1026 has to be multiplied with the present value factor at the end of 7 years at the rate of 12%. That is 4.52. So 1026 multiplied by 0.452 is coming to 463.75. We add all these figures, that is from 1 to 7 year dividend as well as the selling price. So present value arrived at is 563.68. This is the present value. And we also deduct the purchase price in order to arrive at whether the investor is actually gaining profit or not. So for this purpose, the purchase price has been deducted. The purchase price given in the question 500, but again the incidental expenses has to be paid on the purchase price also. So this will be calculated as 500 plus 500 into 5%. So it is 525. So present value 563.68 is more than the acquisition price, which is 525. So 563.68 minus 525 purchase price, that is 38.68, is actually the 38.68 is actually the net gain, or it is a capital gain. Since Mr. E is able to have a net gain of 38.68, then his decision will be to buy the shares of the company. His decision will be to buy the shares of the company. Okay, fine, I think it is 38.68. I think every other students are also getting the same answer, 38.68. Now, the last aspect of the question, what is the maximum price you would be willing to pay? The maximum price you would be willing to pay is actually the present value, which is the 563.68. So this is what about the question number 7. Any doubt which is coming into mind in this particular question, please ask. Yes. Okay, so we have solved the first 7 questions. Let us go to the assignment again. And if you observe that this is the 8th question. The 8th question I have already taken during our previous class on valuation of right shares. When I was discussing the valuation of right shares, I have taken this question. So all the question of this assignment has been covered to you. And I will just revise it, whatever we have discussed during the course of this lecture on valuation of equity shares. So in valuation of equity shares, we have started with taking some of the concepts, that is, which you have already studied in your intermediate: discount rate, that is the minimum required rate of return and the internal rate of return. Then we also arrived at the equity risk premium, that is the risk which the investor is willing to take, or the premium which the investor wants while willing to take risk. We have taken one practical example also in case of the equity risk premium. Then we come to the various models. The present value of equity shares can be calculated with the help of the various models. There are three approaches: dividend-based approach, earning-based approach, and cash flow-based approach. We proceeded with the dividend-based approach as per the Gordon's model, which is very simple model and which is used very widely. As per the Gordon's dividend discount model, dividend is the present value of future cash flow of in the form of dividends. In dividend discount model in Gordon, we have seen various aspects. That is, if the dividend is, for example, if the investor wants to hold the share for 1 year, or he wants to hold the share for a very long time to come. If the investor is willing to hold the shares for a fairly long time to come, then the perpetuity or that formula is generally used. That is KE minus D1 upon KE minus G formula is basically used. Various approaches in this dividend discount model we have seen. That is, the first approach is the constant, you can say zero growth rate. That is, the company is paying at a fixed percentage every year, which is a very unrealistic assumption. Second aspect, we have seen that the company is paying dividend at a fixed rate or fixed constant growth rate. That is 10%, company is paying dividend at 10% rate, and it is increasing every year at the rate of 10%. So this is also a very unrealistic assumption. Practically, the company pays dividend at different dividend rates. So the two-stage discount model and three-stage discount model, we have a more practical approach in which it is assumed that initially the company pays at a very high dividend, which is called the super growth rate, and then it settled at a normal growth rate, which will continue till infinity or perpetuity or for a long time to come. So this approach is followed both in the two-stage dividend discount model as well as the three-stage discount model. So, and then Divya, I will come to your answer. Don't worry. I will come to what you were asking is I will come to you. So next we then come to the earning-based approach. In earning-based approach, the Gordon's model has been taken. You can say the Walters model has been taken. We have solved one question on both the Gordon's model and the Walters model and price earning multiple. Then we came to the free cash flow. Free cash flow, there are two aspects, free cash flow to firm, free cash flow to equity. Free cash flow to firm is the cash flow which is available to both the equity shareholders and the debt holders. That is why it is called unlevered cash flow. And free cash flow to equity is basically the cash flow which is available only to the equity shareholder. That is why it is called the levered cash flow. Free cash flow to equity. Then we see the enterprise value. Enterprise value is generally taken as the takeover value, or the price at which another company will acquire, some company will acquire another company. It is calculated as, enterprise value is calculated as market capitalization plus long-term debt plus minority interest less cash and cash equivalent. We have seen some aspect of enterprise value such as enterprise value to sales, enterprise value to EBITDA, that is earning before interest and tax and depreciation and amortization. Then we came to the valuation of right share, how to value the right shares. We have taken one practical question also, which is in front of you. And lastly, we came to the valuation of preference shares. I have taken the example in case of both the aspect of valuation of preference shares, that is valuation of shares on the basis of, you can say, redeemable preference shares and irredeemable preference shares. So this is what about the valuation question. Now, Divya, I will answer your question. Yes, you are correct. This is maximum price 536 because it included the incidental expenses also. So your another approach would be to consider the incidental expenses also. So I was actually want some of you to ask this question. So I will just stop sharing it. Actually, I want some of the students to ask this question. Then I will be happy to then calculate it. And then I am happy that you have asked this question, that incidental expenses to be considered while considering the maximum price which the investor would be willing to pay. So it will be 563.68 into this 100 upon 105. Because the present value in which the investor will pay, which we are willing to pay, will obviously pay when it at the inclusion of the price which is inclusive of this incidental expenses. So he will be willing to pay which excluding of incidental charges. That price he would be willing to pay. So it will be 563.68 into 100 upon 105. So it is actually 536 point, that is the price of 536.84. 536.84. So preferably this should be the price which the investor is willing to pay, that is 536.84. Any other question on this? Otherwise, I will round it this session. Just hand it over to Ashish sir. I will just stop sharing it.
Okay, no problem. Vivek is fine.
Okay.
Am I audible?
Yes, sir, you're audible.
Okay. Thanks a lot, Vivek. You have taken a very wonderful session. Only 2 or 3 queries I want to discuss with you students. Because one normal query was, student was asking, sir, can we use the Walter model if nothing has been mentioned? As Vivek sir has told us, you can take. But student, here I would like to mention that basically Walter model is basically covered under more in dividend decision. And dividend decision has been now in the intermediate paper. Earlier it was in paper of the old scheme also, but now it is no more in the new scheme, your current existing scheme. So in that case, my advice to you, please use as if nothing has been mentioned, as far as possible, please use the Gordon growth model. Because even I have found that in most of the books, most of the foreign author books, I could not find this Walter model. So I think on account of popularity, on the ground of popularity, my advice to you, please you use the Gordon growth model. Of course, if nothing has been mentioned, then we can consider the other solution also. But still, best option will be to use the Gordon growth model. Now another, I think one student has asked D1 something, but I think he could not, or he could not further elaborate the same. Maybe my view is that because in this type of a question, there is one common question is that, sir, if it has been mentioned that dividend expected, then you can take D1. Okay, if it has been mentioned dividend paid last year, you can take the figure as D0. But problem comes when it has been mentioned that D dividend only. Okay, now in that case the problem comes that what value you have to consider, whether you can take D0 or D1. Now in that case, my advice to you, student, please, you can take any value. Don't confuse in the examination, because simple word mentioning dividend can be presumed either way. Okay, so no marks will be deducted for the same. But if it isn't mentioned dividend paid, so it means generally we consider that as a dividend D0, or dividend expected, of course, D1. But sometimes even D1 dividend paid we may also consider as a dividend expected. But preferably, if only dividend has been mentioned, then you can take either way. Otherwise, dividend paid D0 and dividend expected is D1. So student, I hope with this your queries must be clear. And if you have any query relating to your board of studies, any doubt here, you can discuss with us. No problem. Now, student, since our class is today, class is there now. Your class will be on due to Diwali occasion. Your class will be on 8th of November. Yes, am I correct, baby?
Yes, sir. It will be on 8th of November.
Okay, so you will continue the security valuation there?
Yes, I will start from technical analysis because evaluation of equity shares has been completed. So I will begin
with the technical analysis.
Yes, sir.
Okay, students. Now we shall Vivek sir will discuss with you the technical analysis. So my best wishes of the Diwali and further celebration to you. Stay safe. And Vivek, thanks a lot for sparing your precious time and delivering a very wonderful lecture. And happy Diwali, Vivek, to you also. Okay, students. Thanks a lot. See you on the 8th November 2021. Thank you.